Good afternoon, everyone. This is AJ with FBS Securities, bringing you a quick market recap. And I just wanted to cover some market levels, go over the FOMC overview, and I wanted to cover some model performance. So before I start, this information is for educational and informational purposes only and should not be considered investment advice. So for the day, S&P closed down just under 30 bips and Nasdaq closed down 33 bips. But for the month, very volatile month again. The S&P is down just under 5%. Sorry, the Nasdaq is down almost 5.7%. Year to date, I believe S&P is still down close to 3.5, 3.6%. But we'll get right into some charts. So, for the year, from the highs of the market to the lows, the S&P has corrected almost 10.36%. So we are in a very good corrective sort of territory, but now we're struggling to kind of reclaim this major support level. This was major support, now it's turning into resistance. But as you can see, the past 3 days, almost this whole entire week, we've been struggling to kind of reclaim this 569 level. So that's one thing that I'll definitely be watching moving forward. But we are between two gaps. We have this bearish gap down here, and we have this bullish gap here as well. So we're teeter-tottering between these two gaps. But another thing that I do like is that the S&P is holding a 50% retracement. So if you go down to the 1 hour chart, you will see that S&P has found a nice bid on this 559.7 level, which is the 50% retracement from the lows to the highs. I usually like to watch the 50% retracement levels just to kind of give me an indication of if the momentum or strength is continuing in a particular trend, and at least this is favorable in the bullish direction for now until we reclaim this 569 level. So definitely need to watch this level. So technically, we're just kind of teeter-tottering at least this whole week between these two, in this 10-point range. Now, if we do start to break a little bit higher, I would look to test the first thing I'll look to test is this negative 50% retracement, which would be around a 581. This also does coincide with the gap that we have down here. And of course, we have this major gap that kind of started this whole move lower. Now, if this does start to fail and we do start to move a little bit lower, then we do have another gap down here around 536. Sorry, 535, 536 area. And if we do reach there, then this would effectively be a 12 to 13% correction from the highs, which is, we're getting into a little bit more of a decline. But at least for right now, what I'm watching is to see if we can reclaim this major level. And at least as a firm, we are holding some cash in most of our models, and I'm looking to at least get some confirmation before deploying the rest of this cash to the market. And if we do start to break a little bit lower, then I'll look to raise a little bit more cash as well. So another thing we can look at is NQ futures. Now, the same sort of fib isn't applicable on the NASDAQ itself, but we do have the same fib holding on the NQ futures, so need to watch this level as well. And I think if you look on the Qs, we do need to reclaim this 489 level. And as I mentioned in the previous post, we do need to see some strong momentum and continuation from the semis and technology group to kind of lead the rally higher. And that's the two major sectors that will definitely give us that boost as in the market overall, especially if we can get the Magnificent Seven stocks to catch a bid and help us support the upside move. But yeah, just wanted you to be aware of those downside levels and kind of where we're sitting at right now. So just wanted to quickly, I was making a lot of notes whenever the video conference was going on, but just wanted to quickly recap some of the FOMC meeting that Powell was talking about. So as I mentioned, the rates are unchanged, but they're leaving the door open to make any sort of adjustments throughout the year. And so for right now, we are still pricing in almost 50 bips worth of cuts for this year. And the median expectation for rates is around 3 to 3.2%, or sorry, 3.25% over the next couple of years. For right now, we are only pricing in a 20% chance to cut in the May meeting, but in the June in the later meetings, we have a higher percent chance. Again, this kind of depends on the economic data that is coming out, as well as what the impacts of tariffs, or if there's going to be additional tariffs, and sort of the impacts of those as well. So right now, the Fed's mainly watching for some uncertainties from the new admin in relation to trade, immigration, the fiscal policy and regulations, and how this sort of maps into the market and economy overall. But a good thing that the Feds have started doing is they're reducing their quantitative tightening from 25 billion to 5 billion a month starting in April. So far, since they have initiated this QT, we have reduced the balance sheet by almost $2 trillion. So the Feds are feeling pretty confident to reduce the overall decline per month. So this is a little bit, in my opinion, a pretty dovish Fed, and they're well positioned for any sort of adjustments that need to be made, and watching, of course, the labor market and price stability and things like that. So overall, a pretty dovish tone compared to some of the previous meetings, but just have to kind of monitor and see how the economic data comes into play and how that can factor into the Fed's decision for the next sort of cuts. Now, we'll get into some model performance. So we will start with the large cap portfolio. So large cap portfolio is down just 50 bips on the S&P so far this year. We did have a pretty nice gain to the upside and then had to make some adjustments as the market was moving a little bit lower. But I think as of today's close, this should be updated. We are a little bit closer to being a little bit more in line with the S&P, but a little bit of a lagger. But at least I know on the upside we're able to get some pretty decent alpha on the market. If you look at the earnings model, so before the decline started, we were up almost 9%. And I did have to raise quite a bit of cash in this model as I was watching the earnings report. Some of the earnings report just wasn't as strong as I would have liked. So I chose not to allocate or fully allocate the model. So I was sitting almost 40% cash in this model and just a very small sort of outperformance here. If you can see, the model is down 2.8%, S&P is down 3.23%. If you look at the dividend model, this is positive on the year, so it's almost a 5% outperformance on the S&P. And this one does tend to do a little bit better in market or in volatile markets. As you can see, almost not as affected as much compared to the S&P since it was declining from the highs. But again, have to be a little bit cautious on this model and be wary of changing it. Once the market do start to rebound, I would more than likely reduce the allocation in some portfolios for this model as well. Now, the best performing model so far is our sector rotation. So this one is up close to 7% on the year. And as you can see, during the decline, I think S&P was down almost 11% from the highs. This one was only down 3%. So the defensive sector rotations definitely did pay off for this past couple of months. And I do anticipate, whenever we do start to see some bullish momentum, this will also outperform on the upside. This has been definitely one of the better performing models, but we do attach around 25-30% on this one to specific accounts, and a very, very strong start for the year for the sector rotation model. I do have one more. um where'd it go? No. Is it? Yeah, so this one is the most aggressive model that I have, which we call the booster. So towards the highs, this one was up almost 11%, and even after taking some profits, this did take a pretty substantial hit. But this is the one that I should expect, or you should expect the most volatile movements from. Last year, this model itself performed close to 70%, so I'm not too worried about any sort of upside results or the upside alpha generation from this model. But I definitely don't allocate a large percentage of this model to any accounts. We kind of, look at the risk assessment and see if it's even suitable for something for our clients. But, we do have some flavors that kind of fit everyone's needs. And whatnot. So, this one was up almost 70% last year. It was up almost 12%, but even after taking some profits and whatnot with individual stocks, it did still take a little bit of a beating since this one is more maybe 10 or 11 stocks, so it'll have a more volatile swing. But yeah, just wanted to give you a quick update and just watch some levels and whatnot, and hopefully we start to see some bullish momentum sort of come. I think we'll probably or should expect some news, and hopefully that'll take us to the next leg higher. That's all I have. Thanks so much.